The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon for those of you on the East Coast, and good morning for those of you on the West Coast. We are going to have the second in a series of 3 webinars today on rate issues with respect to the COVID pandemic. We all know the extent of the damage to both the U.S. population, with now over 100,000 deaths, and the economy. The implications are significant for the utility sector. In the first of the 3 webinars that we held 2 weeks ago, we framed the questions, the problems that the industry was facing. In this webinar, we're going to talk about some tools for dealing with those issues. We're going to talk about accounting tools. We're going to talk about rate-making tools, and we're going to talk about different methods of protecting those customers at most risk of financial hardship associated with the COVID virus. So we're going to take both the perspective of the first will be how regulatory agencies can track what's going on. The second is a mechanism, rate unbundling, that would mitigate to an extent the effect of the financial implications. And the third is how do we help customers. In our next webinar on Wednesday, June 10th, we're going to talk about lessons from other financial problems that the industry has faced. I'm very pleased today that we have Bill Steele, who's going to be giving the overview of accounting, Janine Migden-Ostrander, who will be talking about the implications of unbundling, and John Howard, who is going to talk about rate mechanisms for assisting distressed customers. And with that, I would like to turn over to Cheryl Banks, who will, I just had to flash that I need to do the housekeeping reminders. You're able and encouraged to ask questions of the speakers. You will see that there's a chat box on your screen in the GoToWebinar panel. Please write your questions in the chat box and send them in, and then we'll read them for you. So with that, Cheryl, would you like to introduce the speakers?
Yes, certainly. Leading off the 3-person panel speakers today is Bill Steele. He's president of Bill Steele and Associates, LLC. Bill has over 40 years of experience in public utility regulation. His areas of expertise include revenue requirement calculations, cost allocations, cost of service, rate design, cost of capital, and anything having to do with regulation. Prior to forming Bill Steele and Associates, Bill spent 34 years with the Colorado Public Utilities Commission, where he served as an advisor to the commissioners. He's a sought-after speaker, witness, and educator. He often presents to the NRRI Subcommittee on Accounting and Finance. Thank you, Bill, for sharing your knowledge on regulatory assets with us today.
Thank you, Cheryl, and thank you, NRI. I appreciate being here. Hope everybody will have a good day. As you can see by my topic is accounting methods for the interim regulatory treatment of COVID-19 costs. Now, I think it's important to take a step back, especially for people who are maybe non-accountants. I'm often asked, where do these numbers come from? Basically, the Federal Energy Regulatory Commission, FERC, has what they call a uniform system of accounts that all states have adopted. And what this uniform system of accounts has is standardized reporting for revenues, expenses, investment, capital, depreciation, so forth. So everyone basically is using the same reporting format. It's also designed in such that it aids in doing rate cases and rate treatment. and other things as regulatory people need those type of tools. So one of the regulatory tools or methods that we're going to talk about, I'm talking about today, comes from that FERC Uniform System of Accounts, and it's called basically a regulatory asset. So if I could proceed to the next slide, please. So just kind of give you a brief outline where I'm going to be talking about today. I'm going to define what is a regulatory asset. I'll talk about what is the impact of the regulatory asset. I'll give you some basically examples of regulatory assets. See, it's a broad category that will not only cover what is going on with COVID-19, but has covered other areas in the past and will also cover other areas as we go forward in the future. I'll talk about regulatory assets in FERC, as I talked about a few minutes ago. Basically, that's where it comes from, is from their system of accounts, the guidance that state utilities commissions have adopted. Then from there, I'll proceed to the COVID-19 state response tracker. This is an exciting tool that NRRI, NARUC, EEI, and a lot of other organizations have put together. I'll give you some examples from that. And then basically my last slide, I'm going to talk about what are some cost recovery questions we're going to be facing once we've captured all these different costs into our regulatory asset account. How do we proceed from there? How do we deal with that? So that's kind of the last slide, and of course some of our other speakers will be touching on some of the cost recovery options as well. So with that, let's start to proceed to the next slide, where we talk about what is a regulatory asset, okay? So the term regulatory asset refers to a specific cost that, as I have here, a government agency, basically what you're looking at would be state utility commissions as well as FERCs, and what they do is they allow that cost, they permit that regulated utility to defer that cost to its balance sheet. So for those of us who are maybe not accountants, a balance sheet is a financial statement that reports a company's assets, liability, shareholders' equity at a certain point in time. So it's basically what do we own, what do we own, what do we owe, and what's ours to keep, okay? So accounting for regulatory assets allow public utilities to defer the recognition of certain costs, expenses, bypassing the income statement in the near term, and by moving those costs to the balance sheet. So for non-accountants, an income statement basically is a profit and loss, where we have our revenues and we have our expenses, and the difference between those two is basically our net income. So one could start to see why it is very important in this extraordinary time of COVID-19, why a regulatory asset could be very important, because what it may do to the bottom line, the financial line of the utility, what it could translate into rates if it had to basically take this cost in its entirety, say in 2020, and how the investment community would look at that. So that's basically what a regulatory asset is as we go through and we define it. Next slide, please. So what we're doing is we're deferring the cost to a regulatory asset, the cost of, in this case, we're talking about COVID-19, and will allow the utility, after it's been gone through the proper regulatory process, to spread that expense over a longer period of time versus, oh, we'll take all those costs in 2020. We'll allow that to maybe be spread over several years, depending on what the regulatory jurisdiction does. It allows a state utility commission the ability to review those costs at that point in time as well. So you can see basically it helps not have such a severe impact on the utility's bottom line rates. It gives everybody time to collect the information into one central place that it can be looked at, and then when it becomes time for rate recovery, everybody can weigh in on the appropriateness, the different types of rate recovery, which I'll talk about some of those options as I get to the last slide. Next slide, please. So One of the things that I found interesting as I went through and I started looking at NRI's little chart there too, was that when we talked about regulatory assets, I saw one petition that said basically they were requesting, this is the language, for authorization to track and record as a regulatory asset and defer expenses resulting from each asset, each utility's response to COVID-19. Also in there, basically, they're pleaded, they said, this regulatory asset will allow the commission and interested parties to evaluate the recoverability of those costs and other associated issues in separate proceedings separately brought by, in this case, it was a joint petition of the utilities. So that just is some real life verbiage that you'll see as you go through and look at the NRRI tracker and so forth on this. So what are some examples? And actually, when I originally put this together, I put it together to talk to Cheryl's committee in March. COVID-19 got, needless to say, this meeting. But this is some examples you will typically see out there on regulatory assets. So it's not an all exhaustive list, but it gives you some of the key points. So environmental and decommissioning costs, we're seeing a lot of that go on these days as we start to retire some of our old coal-fired power plants and so forth. We have deferred power costs. We have loss on asset retirements. You can have, especially those who maybe still have their own generation, extraordinary repair and maintenance costs. And one of the big items that I think we can all appreciate out there is storm damage costs. You know, yes, we have bad weather, but we're starting to see the frequency of whether it's hurricanes in the south or up in the northeast seaboard. Some of these storms get to be a lot of cost incurred, or out here in the west where I'm out in Colorado or California, other western states, we have a lot of basically damage caused by wildfires. And so there's a lot of costs out there that it makes sense to, instead of expensing these in 1 year, to basically establish a regulatory asset that then we could spread across the cost as well as the benefit over a period of years, while also maintaining rates at a reasonable level. And then the other two bullets you'll see there is debt issuance costs and deferred taxes. So those are some standard examples as you would look through utilities, and I'll talk a little bit more about this coming up. Their annual reports to FERC, state commissioners, to shareholders. These are some of the examples you'll see of typical regulatory assets. Needless to say, what we're here today to talk about on COVID-19 is probably once in probably a lot of our career times, a lifetime, but it is there and we need to deal with it. And one of the accounting ways that we can deal with COVID-19 related costs is through the establishment of a regulatory asset. So if we could go to the next slide, please. Okay. So how are regulatory assets established? Well, as I just read to you, and you'll see as you look at the NRRI, NARUC, EEI, basically COVID state response tracker, is basically what you'll see is companies will file a petition, an application, whatever the appropriate language is in their respective states, and they will ask the commission, as I read from that little excerpt before, saying we would request the commission take these related costs. They'll specify what the cost subject is, and we would like the commission to allow us to establish a regulatory asset. And the way that is established by the commission is the companies will ask for an accounting order. And basically what that accounting order does, it's a placeholder to allow the companies to take these related costs, put them in the regulatory asset account, and there'll be a lot of different items in that account. So you'll see basically numeric additions to the uniform system of account numbers that allow each one of these to be tracked until, as we said, such time that the utility can come in and there can be a full vetting of the issues of cost recovery. So a utility will file a pleading. That pleading goes through the normal, basically due process process at a particular commission. and then if the commission finds that it's should be granted, they'll issue basically an accounting order. Now, just the issuance of the accounting order does not guarantee cost recovery, but what it does is it allows the utility to basically book those costs in a regulatory asset. Okay. Now, without those costs, basically the utilities certified public accountants would say they're going to have to be written off because we have no probability, as that last bullet says, that you may have future cost recovery by deferring them. So that's one of the things that the regulatory asset does, is it puts them in a defined, basically, account. It allows the probability of maybe future cost recovery, and then it also allows all the parties the opportunity at a future date to weigh into some of the cost recovery issues. So it's a benefit to the utility. I would say it's a benefit to the commissions to have times, and it's a benefit, in my opinion, and this is just Bill's opinion, to consumer groups to have the additional time to evaluate these and literally let the dust settle on these issues. So next slide, please. Okay. So basically, what you'll find, again, as I mentioned, the Federal Energy Regulatory Commission has basically accounting requirements. Again, it's called the Uniform System of Accounts. And as this language is from there, I'll basically summarize it. It says that they're to be established for charges that would have been included in the net income under the general system of accounts, but for the probability that these charges, these expenses, may be used for developing rates at a future date. Again, if we didn't have COVID-19 and I was giving you this talk, one of the ones I would probably focus into is the extreme storm damage we've had as an example of regulatory assets. But we have COVID-19 and we're here, and you can see basically we have an accounting method through our FERC system of accounts that have been adopted by states to allow us to start to capture, record, and identify these costs, and that mechanism is a regulatory asset. As the next bullet said, basically regulatory assets, they're not developed for day-to-day operations. They're developed for unforeseen circumstances that, under normal circumstances, the utility would be able to recover. One of the things that people often ask me is, well, where can I, if I want to see what the utilities in my state or have for regulatory assets and so forth? Well, again, FERC has the system of accounts that they require reporting annual reports to them. The FERC Form 1 is for those that are electric utilities. FERC Form 2 is the gas utilities. There's an actual listing, a schedule of regulatory assets. States have a very similar, where they will have them file a state FERC Form 1, a Form 2, and states may have additional schedules. So you can actually identify what these regulatory assets are, what the dollars that have been booked into these accounts by looking at the various annual reports. Okay, so next slide, please. As I mentioned, the FERC Uniform System of Accounts is a very comprehensive basically document. It ensures uniformity, it ensures transparency. It's very much driven where it's very specific. So one of the things you'll find as you look through the FERC system of accounts, and I just have pointed to this, is that besides having an accounting number for what basically a regulatory asset is, they also have a definitional section. So if you need to know when you're looking at accounting things, or in this case, you can go to the FERC Uniform System of Accounts definition number 31, and it will list those out there, okay? So again, very similar language. The one I read to you earlier was actually FERC has accounting interpretation letters, orders, and so forth. It's from there. So basically, as you can see, it's for things that are not normal, but you can book it in that account because you're hoping that somewhere down the line, you will receive some type of cost recovery for these extraordinary and not normal type things. The last bullet you'll see there is if there was actually a regulatory liability that that credits or refunds would have to be given back to customers, you would see that. But again, for the purpose of our presentation, we're talking just of the assets, those expenses that we're not going to basically run through our income statement and have it impact our financial bottom line this year, but we're going to put them on the balance sheet, and then we're going to examine them at a future point in time. Again, in order to do that, there has to be a filing, there has to be a granting by a commission of an order establishing a regulatory asset. Okay? Next slide, please. One of the things you'll often hear is that in the accounting that utilities don't necessarily follow general accepted accounting principles, like they're off doing something different. Utilities follow general accepted accounting principles except in certain circumstances, and one of these is this circumstance. So as I have titled up there, there's actually a financial accounting standards board that basically comes up with accounting standards basically for the, not only for the utility industry, but for the whole accounting industry. And they will also periodically issue statements of financial accounting standards. This one is called 71 and its regulatory tools. And basically what this says in English is basically the difference is if a utility may be able to defer certain costs to their income statement under certain conditions. Again, this is if they have this establishment of a regulatory asset from a state utility commission, that there may be the probability of cost recovery in the future. The last bullet, I think, is very critical when we're looking at why a regulatory asset is so important for the environment we're dealing with, because as you read that last bullet, it says, in the unregulated world, a business would be required to record an expense at the time it's incurred, regardless how abnormal it is. So in the case of all these other businesses that are not utility rate regulated, they're going to basically have to write off all these COVID-19 expenses basically to their net income. It will basically have a significant impact on their financial statements. One of the things, as you have the opportunity to look at the NRRI tracker, and one of the big issues that is lurking out there that's probably different for the utility industry versus other non-utilities is the whole issue of disconnect. It's one of the big issues that basically state organizations you'll see, and that NRRI NRRI tracker is that there's been a prohibition for a certain period of time of turning off and disconnecting people, collecting late fees. That's going to be a huge issue out there that probably other businesses are not facing. They just stop serving people. So basically what this slide says is there's an accounting provision that will allow, if a commission declares this a regulatory asset, to allow them to defer cost recovery versus expensing it in, say, 2020. So it's the accounting world recognizes the importance and the difference between utility operations and the rest of the world, and that's why they actually have this pronouncement on what a regulatory asset is. Okay, next slide, please. I've mentioned several times, but this is a document. When I first looked at it, I was just very, very ecstatic over it, that it's actually entitled the COVID-19 State Response Tracker. And as you can see by the title up there, the first bullet, NRRI, NRRI, EEI, other industry groups have coordinated to put this tool together to track state responses to COVID-19. That's the website. It's an amazing document out there that I think will be a lot of value to utilities to see how other utilities have been being treated in different jurisdictions, for state commissions to also see what's being done, consumer advocates, take your pick, but it's a very comprehensive document. I just, for basically the sake of giving you a flavor of what's in this document, just pick some examples here. And as you can see, and this is basically cut and paste from the document, we actually have a listing by state, the date of the action, the type of document, and description. And I basically random picked these because basically the text fit nicely into my PowerPoint slide. It's not that one state is doing something better than the other, but it's to give you a flavor of what an important document and source this is. But as you look at the one on Iowa, it says the Iowa Utility Board orders COVID-19 impacts to utilities and authorizes, what are they authorizing? Our regulatory tracking accounts, basically our deferred asset accounts. As you go down and you look at the next one for Nevada, Nevada was, early on this, directs all regulated jurisdictional utilities to track expenses. Okay, so you'll see that as well. You'll see, and not only will you see, like, say, this entry for Nevada or Iowa or Pennsylvania, but you'll see numerous other entries of all the work that these different states have done. So I encourage you to use this as a resource, because this is one of the things that will allow people in our industry to do their job. But the basis of us being able to do that job, to start to do it, is, as you can see here, the establishment of a regulatory asset. So the next slide, please. This next slide, and this is the last slide of my slide deck, so I thought this would be a great way to end this. Often, as I've found, and when I've advised commissioners or clients or have taught, many times we have more questions than necessarily answers. But I have enough faith in the industry and the people who are out there in the regulatory environment that will work through these. They'll probably be worked out jurisdiction by jurisdiction, potentially, utility by utility. But that's where groups such as NRRI are invaluable to basically start teeing these up to serve as a source, as well as NARUC, as well as the consumer group. So these are just some of Bill's questions. Now, they're not intended to be an exhaustive list, but these are some of the things, as I talked to my fellow panelists, we started thinking about that, yes, these are going to have to be addressed. So I'll just walk smartly through these. I don't have necessarily an answer, but I tee it up because this will be something we're going to be talking about for quite a while. So one of the questions that came to my mind initially is what COVID-19 costs should be allowed in rate making. Okay. You often hear some costs are basically the normal cost of doing business and should basically be recovered in the normal way. There'll probably be some people out there, as the second bullet shows underneath that title, is identifying and quantifying what costs are directly caused by COVID-19. There'll be a big debate on what those costs are, or what costs are normal operating business costs and should be recovered in the normal way, and what should be recovered as COVID-19. The next one is determining the appropriate rate-making treatment for those costs, because basically sooner or later the utility will want to have cost recovery, and everybody will watch and make sure that the cost recovery is appropriate. So basically, again, determining the rate-making treatment for COVID-19 costs. So the question I just pose here is, well, will it be total cost recovery? Will the utility get everything they say is COVID-19 related costs? Or will some of it be partial? Again, some of it is a normal operating business expense, or is it all COVID-19? The other thing you'll see often when we have regulatory assets is because we're spreading out the impact and not taking the impact of them in 1 year, otherwise we would be an expense. And so what period would we amortize these costs over? 5, 10, 15, 20? I don't know, that'll all be debated out there. And one of the things you'll also see is, say, if we gave a 10-year amortization, in year 1, the company is allowed in their income statement to recover 1/10 of that COVID-related 19 cost, you still have the other 9/10 that haven't been recovered yet. Should the investor be able to earn a return on that money they already spent on COVID-19 costs, or shouldn't they? Or if they should, at what rate? I mean, you can start to see we have a lot of exciting issues out there. And one of the things I also found is that at what point in time should we say cost recovery of COVID-19 stops for rate making? Like anything else, things can't go on forever. At what point in time do we say, yeah, it's done? Good question. I don't have the answer. Okay, one of the things that you'll see is the next bullet is what type of reporting information should commissions require in order to get COVID-19? Yes, they're going to be putting them in these, regulatory asset accounts, but at the end of the day, there's going to have to be some reporting. And let's face it, somebody's going to ask, whether it's the governor, the president, chair of FERC, whoever, okay, what has been the overall impact? So you might want to consider what the reporting format will be. I've heard some people advocate, commissions will be pretty busy. Consumer advocates, should we require the utility to have an outside audit to verify what the COVID-19 costs are? And the last bullet is, should the discussion of the recovery of COVID-19, okay, when we get to the point of cost recovery, remember that's one of the purposes of establishing a regulatory asset is to basically capture those costs in one place, and then at the appropriate time discuss whether they should be allowed in rates. Should that discussion take place in a general rate case where all issues are up for debate, or should it be in a separate proceeding? And also, so those are the issues you have. So with that is basically the end of my presentation on the accounting methods for COVID-19, and I will be glad at any point in time to entertain questions. The first slide also in my presentation has my email address, so if somewhere down the line you have questions that you don't ask today, feel free to contact me. So with that, I'll turn the floor over back to my moderator, Cheryl and Carl.
Thank you, Bill. That was terrific. One of the great pleasures of being the director of the National Regulatory Research Institute is to help share with the regulatory community just how interesting and vital many of the various aspects of the expertise that makes up the community, and you certainly have done a wonderful job explaining the role of accounting with respect to the COVID crisis and the relevance of accounting with respect to people's lives and the industry's well-being. Cheryl, we ready for our next speaker?
You're muted.
Yes, Carl, that'll be fine. I think we can hold the questions to the end. So let's go ahead and move on with our next presenter. Our next presenter is Janine Migden Ostrander, principal with the Regulatory Assistant Project. In her role, she advises regulators and advocates on regulatory policy. Janine has worked in public utility law for over 35 years. She recently assisted the Energy Bureau of Puerto Rico in establishing orders and regulations involving integrated resource planning and microgrids. She has authored numerous articles and has also served as a lecturer and educator on regulatory issues. Prior to joining the Regulatory Assistant Project, Ms. Migden Ostrander served 8 years as the Ohio Consumers Counsel. It's my pleasure to welcome Janine.
Thank you very much, Cheryl. Greetings. I'm going to be covering 3 subjects with respect to revenue decoupling in the time of COVID-19. So the first will be an overview of revenue decoupling and how it works, a discussion of design options in decoupling, and then specific considerations with respect to COVID-19 as it relates to decoupling. So first, I just want to point out that decoupling was originally put in place as a mechanism to encourage utilities to do energy efficiency and remove the barriers to energy efficiency, because when utilities engage in this practice, you're telling them to sell less of their product. And so the whole concept behind decoupling was to make them whole and help them to recover the lost revenues. As you can see from this chart, energy efficiency makes a lot of sense as it is the least cost option. From 2006 to 2016, retail sales of electricity in the U.S. increased by 2.5% nationally and declined by 27% and declined in 27 states. And this chart comes from a report on that we did on the benefits of electric energy efficiency, and we refer to this as our layer cake. And from this, you can see that there are numerous benefits for energy efficiency, from utility system benefits, participant benefits, and societal benefits. I'm not going to go through all of these now, but I encourage you to go back and take a closer look at what RAP refers to as our layer cake of benefits. So let's take a look at rate of return regulation. Under rate of return regulation, utilities can increase earnings three ways. They can increase their operational efficiency, thereby reducing costs. They can sell more energy, the throughput incentive, and this is what decoupling was designed to address. Or they can build infrastructure for which they earn a return on their investment. So a refresher of the rate-making formula, because revenue requirements are at the heart of this, is you have test year expenses plus depreciation plus tax plus the rate base multiplied by a rate of return. So this is where the utilities make their profit through the their investments in rate base. So what decoupling is designed to do, it is designed to address the throughput incentive by breaking the link between utility sales and revenues. The way it typically works is that a utility will come in and file for a rate increase, and during that time, the commission will establish the revenue requirements. And after a period of time, typically a year, but it does vary from utility to utility, there will be a opportunity to do a reconciliation adjustment, under which the commission will look at what were the authorized revenues as compared to actual revenues, and they will make an adjustment either up or down to reflect that that change. So this is an illustration of how decoupling works. So let's take a look at this hypothetical whereby you have target revenues of $10 million, of $10 million, a test year unit sales of 100 million, and so that provides a price of 10 cents per kWh. If after a period of a year or whenever you're doing the reconciliation, you determine that actual sales are 99,500,000, so in essence a reduction of 500,000, there is a requirement for a price increase of a nominal 0.05 cents per kWh. So it's a very small adjustment in this particular hypothetical. But let's look more globally. This chart shows you the size of the kinds of adjustments that have occurred as a result of decoupling. So you can see that most of the changes are in the plus or minus 1% range. And so not very significant changes in terms of either a surcharge or a refund back to the customer. And just very quickly, the Standard & Poor's takes a positive view of decoupling from a credit perspective because it has a number of benefits for the utility company, including giving them the opportunity to earn a predetermined level of revenues regardless of the kWh impact. And also it reduces the need for future rate cases, which results in significant savings for not only the utility, but for the regulators and all the interveners that participate in these cases. So the next thing we're going to talk about is how you design decoupling. And this is a very critical point I want to make, which is that no two decoupling mechanisms are alike. Every utility, every state does it differently. And there are a lot of design options. So the regulators really have a lot of tools in their hands to design a decoupling mechanism that works for them. So when people say, oh, you know, this is how I feel about decoupling, I always want to know, well, how is yours structured? Because that really makes a difference. So the first issue that we look at is what functions is the decoupling going to be applied to? Is it just transmission and distribution, or is it transmission, distribution, and generation? Obviously, if you're a restructured utility that only provides wire services, it's going to apply only to that and not to generation. If you're a vertically integrated utility, you can apply it to all three functions or just the former two. Typically, we've seen that it's been applied to all three functions. Next is the ability, the applicability to customer class. So you have the residential and small customers or all customers. In some communities, in some places, it's just applied to residential and small commercial because the thinking is that they're a more homogeneous set and it's easier to determine a fair decoupling mechanism. With industrial customers, you have different levels of sales and also demand charges that very much impact what an individual industrial customer's bill is going to look like. But keep in mind, if your decoupling mechanism does not apply to large commercial and industrial customers, you can't collect lost revenues from residential customers if those businesses are not part of that decoupling mechanism, are not participating. So what costs are included? Is it just base rate costs? Is it riders? Is it some riders, not others? You might want to give consideration to limiting recovery to base rates only, although you could do it in other ways. Some riders, like fuel costs, for example, are based on consumption and are a dollar for dollar recovery. Other riders are policy-based, like a systems benefit charge. How frequently should you have rate cases to determine the revenue requirements? After all, you're basing the adjustments on the revenue requirements from the last rate case. Some utilities, some commissions have decided to just let the utility determine when it needs to file for an increase. Others require a mini or full rate case annually as part of their decoupling mechanism, or others have said, we want the utility to come back in 3 to 5 years so we can take a close look at things. The mini rate case probably works best to adjust revenues to recover costs during COVID-19 because it's the quickest way to determine what costs in base rates were reduced and what were not recovered and for which the utility might have some exposure. And some examples of potential COVID-19 costs include suspension of tree trimming or meter reading where there's no smart meters, furlough of non-essential employees, and also decreased usage of expensive peakers because the demand has gone down. The utility doesn't need to fire up those units and they're saving a lot of money in so doing. Another question that comes up is whether or not to adjust the return on equity because there is a lower risk for the utility company. And this is something that sometimes consumer advocates advocate. We like to point out the fact that when you have decoupling, you may be able to rethink your debt equity structure and increase debt and decrease equity, and thereby borrowing at a lower percent. And by doing that, when you look at the weighted average cost of capital and apply it to the rates, you can see savings to customers in that manner. So now we're going to get to the heart of decoupling. This is probably the most critical question to answer, and that is what kind of revenue adjustment mechanism are you going to use? There are 6 adjustment mechanisms. The first one is not to have an adjustment mechanism to the revenue requirements. So whatever the revenue requirements are that are determined in a particular case, they stay in place until the next rate case. It would result in recovery under COVID situation. It could result in recovery of lost revenues based on the last, since it's based on the last rate case, and not capture the reduced expenditures during COVID-19. It would require a new rate case. And if there is a new rate case, using historical test year that covers part of this COVID-19 may not be a true reflection of what rates are going to be going forward or what the economic situation is going forward, assuming optimistically that we are in recovery. And so if you use a future test year, that's sometimes consumer advocates have concerns about that because it's based a lot on estimates and not on actual information of what's known and measurable. Stair stepping. These are predetermined adjustments made in the last rate case based upon forecasts of projected cost increases. So, so it could be things like, you know that there's going to be a new labor contract going into effect during the year, the next year, and so you would take that into account, whatever the new labor rates are. It would be necessary to review whether those future costs would still occur at the same level, because there are a number of adjustments that you might put in a stair step, but because of COVID-19, they don't quite occur. Indexing, another mechanism, is where you adjust the revenue requirements based on such factors as inflation, industrial productivity, customer growth. If you're basing it on customer growth or industry productivity, you may want to examine, is this the right mechanism right now, given the uncertainty of the situation that we're in? Revenue per customer is probably the most popular mechanism that is in place. The revenue requirement is determined on a per customer basis and is adjusted for the total number of customers served. This adjustment would be would allow for more accuracy in terms of reflecting the number of actual customers the utility has, such as if businesses close and what is the new number of customers. So I showed you earlier a chart that showed the periodic decoupling calculation. Now I'm going to show you, add a layer into it to show you how it works with a revenue per customer calculation. So you come to your price of 10 cents as before, and you insert, you have 200,000 customers, and so you divide that 200,000 into the target revenues, and you come up with a number of $50 of revenue per customer. So in this hypothetical, the number of customers actually goes up, and so you would multiply the number of customers by the $50 to get a new target revenue requirement. And then you would take a look at what were the actual sales, and you would do the calculation to see the adjustment. In the case where we are right now, probably the number of customers is going to be on the decline. And if that happens, then the target revenues would also go down, and you would compare that, do that calculation accordingly. So the impact of a decoupling adjustment on customers might be significantly less based upon how many customers there are. The other mechanism, which is also popular, is known as annual review decoupling or attrition decoupling. Rates are periodically adjusted for incremental and decremental known and measurable changes to rate base and operating costs. Note that an attrition adjustment would allow for a downward adjustment to reflect further depreciation of capital assets. This mechanism would provide an accurate way to adjust rates based on known and measurable changes in costs resulting from COVID-19. So it's actually a good mechanism to keep in mind at this time. The K factor is an adjustment used to increase or decrease overall growth in revenues between rate cases. And then the hybrid allows regulators to combine various revenue adjustment mechanisms in order to adjust rates. And I would say that under COVID-19 scenarios, that using both the attrition adjustment factor and the per customer, combining revenue per customer mechanism, combining those two would be a pretty good mechanism, because it would allow you to account for numbers of customers and also changes in costs and expenses. So the next thing is symmetry. It's somewhat of a no-brainer that if you're going to allow the utility to recover for any under recovery in revenue requirements, if they over recover, they should also be given a credit. And this is a selling point for consumer advocates, because it gives them a way to sort of keep an eye on utility expenditures and revenues and make sure customers are not overpaying in between rate cases, because consumer advocates, to file, if they suspect that, it's very difficult for them having the burden of proof to file for a rate decrease. So it's a good mechanism to have it symmetrical, and it's fair. Okay, allocation of refunds and surcharges. So you can do it across the board, or you could do it by customer class or by rate element, and I'm going to focus on the first two. Customer usage data may demonstrate increased residential usage and decreased industrial usage during this time. For example, AEP in April, their revenues fell 10% to $3.7 billion. Profit was $496.2 million, and sales dropped 12% overall. But residential sales were up 6%, and commercial and industrial sales down 7.7% and 10%. Respectively. So on a customer by customer class, the residential customers could see a refund, whereas the commercial and industrial might see a surcharge. Across the board allocation spreads the charges to all customers, just sort of takes the net of everything and spreads it across to all customers. And note that when you're doing that, you might want to consider the customer contribution to load in terms of determining the appropriate allocation. And keep in mind, in terms of how you do this, that customers who have higher arrearages and may have been furloughed, the optics of putting a lot of the cost on the residential class may not have very good optics. Okay, adjustment mechanisms for refunds and surcharges. You can either do the refund and surcharge through a rider or through base rates. Note that if you do it through base rates, in some states, depending upon their statutes, it may be viewed as an increase in rates that cannot occur except with a rate case. So the rider mechanism, it might be the choice in that instance. Frequency of true-ups or refunds. Most utilities use the accrual method, which allows up to 1 year to you accumulate the amounts for up to a year, and then you have the adjustment at the end of the year. Baltimore Gas and Electric is one of the few utilities that uses the current method. The benefit of the current method is that you don't have any carrying costs for the deferrals, but the benefit of the accrual method is that you don't have as much volatility because you're spreading out ups and downs throughout the year and you're sort of levelizing it out in the same way a budget bill might do. Caps on refunds or surcharges. This, I think, is an important issue right now because the concern is if utilities are losing substantial revenues and you use decoupling as a mechanism, our customers are going to see huge rate increases. So you can put a cap on the rates. It could be based on either revenues or it can be based on rates. One utility had a solid dollar amount for the amount of adjustment. And then the rest of the amount would be deferred for recovery in the next adjustment period. And that takes us to the carrying charges for refunds and surcharges, which would address the carrying charges for any amounts that exceeded the caps that were to be recovered, and also for the amounts under the accrual method that would be accumulating during the year until the next adjustment. So you could use a risk-free rate, you could use the cost of the interest rate on customer deposits, a weighted average cost of capital. In any event, you should have symmetry. So whatever the carrying charge is, it should apply for both refunds and surcharges. So key takeaways. Decoupling is flexible, it's customizable, it's been done before, so models exist. It can serve policy goals of most states, and it can be designed to protect consumers. So policy considerations for decoupling in the time of COVID-19 include things like the fact that decoupling was traditionally used to compensate utilities for lost revenues associated with distributed energy resources, especially energy efficiency. It was not intended to protect utilities against the effects of cataclysmic economic contraction. And so these are considerations that the commissions will need to think through with regard to how they want to handle using decoupling. And if decoupling is now going to be used for economic stability purposes due to lost revenues, what mechanisms should be used to address decreased costs during COVID-19 that should offset the revenue requirement? Other questions commissions might ask themselves: what are the impacts on labor costs? What is the revenue impact of declining sales? What about moratoriums on disconnection that have created short-term revenue deficiencies? How much of that will be recovered? And when it is recovered later on, how is that addressed in the decoupling mechanism? Typically, if there's an annual review, given these circumstances, should the reviews occur more frequently, like every 6 months or maybe even quarterly? Are utilities able to recover bad debt through a rider? And if bad debt is an uncollectible expense in base rates, compare the size of the allowance in base rates to what is the actual bad debt accrued due to COVID-19 and adjust accordingly. Are utilities still recovering a substantial portion of their revenues because they have high fixed customer charges? Some utilities have straight fixed variable rates, so they're getting the lion's share of their revenues from their residential customers. And a lot of utilities also have demand charges for commercial and industrial customers. Are they still collecting full demand charges that are giving them a good portion of their revenues as well? So that needs to be taken a look at in terms of what is the real impact on the utility's revenues. Has the utility experienced savings from reductions in commercial activity which has improved the load shape, and that results in lower average power supply costs, so that high-cost resources such as peakers are not needed. So are they saving money in those ways? Is the utility benefiting from a sharp drop in borrowing costs? Can they refinance? And if they refinance, can that save the customer some money? And should there perhaps be a downward adjustment to the rate of return to reflect that? If fuel costs are included in the decoupling mechanism, how has the steep drop in oil and gas prices reduced fuel costs? Are there savings there? And how does the utilities rate of return on equity compare with other industries? A policy question is whether they should be getting a much higher return than other businesses at this time. Additional considerations include if customers, and I think John is probably going to go into this in a lot more detail, but it should be part of the whole discussion. If customers are going to make utilities whole, then the quid pro quo needs to be extended payment plans tailored the customer ability to pay, and where applicable, waiver of fees to third parties who collect bill payments in cases where customers do not have bank accounts or credit cards. Should there be refunds of deposits? Should the late payment charges be waived so that customers can catch up with their bills and avoid, and should there be other tools to help customers avoid disconnection? And also, utilities should invest in all cost-effective energy efficiency measures and programs, especially targeted to low-income and marginalized customers. So key takeaways. If a utility already has a decoupling mechanism, examine if changes are needed to the design to accomplish your goals. Carefully evaluate the economics of the utility to determine which adjustments are required. Ensure that decoupling includes consumer protections, and it should be accompanied by a commitment to comprehensive energy efficiency, especially targeted to vulnerable populations. And here are some RAP resources. We have tons more. I would urge you to go to raponline.org for more information. And here's my contact information. Feel free to contact me at any time with additional questions. Thank you.
We have one quick question that maybe Janine, you could touch on. The question is that if a commission has not approved a decoupling plan right now, they don't have one. The question is they're assuming it would be pretty difficult to do it right now during this state of emergency, unless they already had a proposal filed in advance of this. So the question is there any other tools that might be available that could be implemented quicker? I assume to recover some of these lost revenues.
Well, I think what you could do is take a look at what the revenue requirements were from the last case, and then do sort of like the mini rate case adjustment, which is done in some jurisdictions on an annual basis that use the attrition adjustment mechanism. So you could have start as the base, the current revenue requirements, then take a look at what adjustments and changes need to be made in expenses up and down and other factors, and then come up with a new revenue requirement that would then be the baseline from which you would apply a decoupling mechanism. And again, some of that might vary based upon what your statutes allow you to do. So, that would be something to look at. But if you're not adjusting the revenue requirements, or you're not really adjusting rates, you might be able to do it. So the first question is what does the law allow you to do in your jurisdiction? If you have that kind of flexibility to create a rider for decoupling, as long as you use the initial revenue requirements, you might be able to do it.
Thank you. So moving into our final speaker is John Howitt. He's the Senior Policy Advisor at the National Consumer Law Center. John participated in the first webinar in this series, in which he shared tools for developing programs designed to ensure low-income consumers access to reliable and secure sources of electricity. John has roughly 40 years of experience in energy policy and programs, but for the past 21 years, John has worked at the NCLC, where he manages a multitude of projects related to low-income energy affordability and efficiency programs. In addition, he has worked on programs on rate design and metering technology. John, thank you again for taking time to share your thoughts with us today.
Well, thank you very much for the invitation to participate. I appreciate it. I hope you're going to be able to see my screen in just a moment here. Can you see my screen?
Yes.
Okay, thank you. Well, hello, and thank you folks for taking time out of your schedules to join this webinar. I know for me, I did have to clear my very crowded social calendar to make time for this, but I'm hoping that it's worthwhile. National Consumer Law Center is a low-income law and policy advocacy group. We work on a broad range of issues of importance to low-income households. I'm going to focus on utility bill assistance programs with a particular emphasis on the crisis we're faced with today. This presentation should be entitled Low-Income Utility Bill Assistance Programs, because while it doesn't say so in this slide presentation, the intent here is to look at and discuss programs that would be available to households that are defined as low income, perhaps those who are eligible to participate in the low income home energy assistance program or some other means tested energy program. So I just wanted to put that clarification out there. There are certain objectives in designing a low-income bill assistance program that would like to talk about quickly. And you'll see that this presentation varies from the ones of Bill and Janine. This is more of a programmatic approach to the current pandemic. Theirs has to do with regulation and rate making more directly. So this is sort of a different tool in the toolkit for folks to consider. But in designing a low-income affordability program, the main objective is really to lower that home energy burden among participants to an affordable level. And by home energy burden, referring to that proportion of household income devoted to a particular utility service or the combination of utility home energy services that the household uses. The first item that I believe is vitally important in looking at program design has to do with comprehensiveness. It's critical to look not only at the affordability of current bills that are coming in, but also the extent to which customers face utility debt and back bills. And this is especially important in the current situation we're in, where many utilities have adopted moratoriums that will at some point come to an end. What are we going to do with all that debt? And by comprehensively looking at program design, I think there may be some answers for us. Another objective of these programs is certainly to reduce disconnections for non-payment. Bill had mentioned that with non-regulated businesses, if a customer doesn't pay, the service simply ceases. Well, home energy service, as we know, it's a basic necessity, without which health and safety is compromised, among a number of other problems that arise. We also, in adopting programs that reduce customers' bills and help them with paying back debt, would be to reduce the credit and collection costs associated with what the utility would normally do to collect money from customers. And I think this is a longer discussion than we have time for today, but enhancing equity is arguably a very important aspect of utility affordability programming. So some design fundamentals. The mechanism should provide, the funding mechanism itself needs to be reliable and predictable. Some fuel fund structures, for example, don't really meet those criteria. And while they can help, to have a regular, predictable funding stream is important for major programming. There are a number of prevalent models. I'm going to discuss one in particular in a couple of minutes, but the prevalent models available or implemented today include a straight discount where a percentage of the bill is reduced. There's a percentage of income payment plan where the participants' payments are capped at a certain proportion of that household's income. And then there's a bit of a hybrid approach known as a tiered discount where income categories and benefit levels are established ahead of time. A target burden level is established, and households within income tiers have their payments reduced to a proximity of that target burden amount. So back to this comprehensiveness notion, arrearage management is a term that refers to customers making timely payments on a discounted current bill and having in that process a proportion of the outstanding arrearage written down. And this gets back to the idea of a regulatory asset and perhaps contingencies associated with such an asset. How is a utility going to deal with these costs associated with reduced revenues? Arrearage management programs, particularly when combined with discounted current bill programs, are a means of doing that. I would mention that in a couple of cases, states have adopted an approach with sort of a one-time wiping the slate clean for eligible customers without paying off that arrearage over time. In New Hampshire and Vermont, that model was adopted, but it's really more the outlier. In designing arrearage management programs, rather than making them punitive, it really is important to start from an assumption of good faith among the customer. If a low-income customer misses a payment, they shouldn't just be tossed off the program, but instead give second and third bites at the apple, if you will. Be willing to negotiate terms that make sense for the customer. And then if a customer does miss a payment and there's a threat of being tossed off the arrearage management program, allow that customer to make up that back payment and don't punish them for the lack of affordability they may be experiencing, but let them back on if they can make good on the back payments. Administrative efficiency with low-income bill payment programs, comprehensive ones, is truly important. We want to minimize administrative costs so we can maximize benefit costs and keep overall program costs at a manageable level. I think with respect to arrearage management, it's very important to build in a communication component. It's important to be in touch with customers to let them know how these programs work and that if they can stay current on that discounted current bill, that they are receiving a major benefit. So those are just some very basic elements. I wanted to point to some tools NCLC has developed that are available at no charge. These are, we're not trying to sell any of this stuff, but we have tools that provide assessments of electric customer arrearage scenarios, an issue brief on utility credit and collection data, reporting and distribution. And we also have a program, a low-income program design template that I'm going to go over right now. If I can get my screen back on here. All right. All right. Are you seeing my screen or? Oh boy.
John, yes, it's there. It's your spreadsheet.
All right. I'm going to try to, all I can see is my mug here. Can you still see my screen, my spreadsheet?
Yes, the APS tier discount worksheet.
Oh, good. I am relieved. Don't you all love this technology? All right. Well, I wanted to go over in just a couple of minutes here a program design template that can be readily altered with input assumptions in a very short period of time. So I'm using Arizona Public Service as an example here, but this can be tailored to any number of different utility applications, utility service territories, consumer protection models, but the template provides inputs to develop proposals or to do analysis of the costs and benefits associated, in this case, with either a straight discount, a tiered discount, or a percentage of income plan. I want to focus in our short time just on this tiered discount model. And in this sheet, you'll see that what the tiered discount does, and by the way, the yellow shaded areas these are inputs that can be altered and the changes run through the entire model. But we want to establish a target burden level. In this case, I've chosen 5% as almost arbitrarily as a number to cap the payments among different customers. We've established discount tiers with the lower tier being 0 to 75% of poverty. And you'll see that for each of these income tiers, as they go up, the benefit levels go down. So for the highest income, or excuse me, the highest poverty level, we have a discount of 79%. But for those at sort of the upper edge of this discount program, get a much smaller discount of under 4%. So I'm going to show you these inputs where they come from in a moment. But just by way of illustration, say, oh, by the way, here, the total cost of year one of this hypothetical program is $58.6 million. And this would serve 56,000 of APS's low-income customers. But if we wanted to change this target burden level to, say, 6%, we see the program cost drops to $47 million. Similarly, we have an assumed average pre-program arrearage amount for program participants, and this again getting back to the comprehensiveness of these programs. I've just assumed $400 is the average amount, but if we find out in the course of dealing with the utility and the regulator that the average amount of low-income arrearage amount among low-income customers is actually $200, we see again the program cost drops significantly. There are other inputs. We can choose the number of customers per income tier we want to serve in this program. We have an average expenditure, undiscounted expenditure amount of $1,570, and I'll show you where that comes from in just a second. We've also assumed a 5% administrative cost associated with this program. Now, the expenditure level is critical because if we're going to reach a target burden level of, in this case, 5%, how much, what is the cost of discounting customers' bills to that amount? Well, you have to start with the undiscounted expenditure level. And for this, I'm going to go to, Bill had mentioned the FERC Form 1. These are publicly available documents, but we see for APS's FERC Form 1, the average residential expenditure is $1,570 a year, And this is the product of the kilowatt sales, the kWh sales per customer, and the revenue per kilowatt hour sold. It's just, you know, so we see sales times revenue, we get the average residential expenditure. And we also get here, we get a monthly figure on expenditures, the average monthly bills for each of these residential customers, and for the program that we've proposed here, it's approximately a $60 million program. There's a calculation that is generated in this tool of what the monthly bill impact associated with that program would be. In this case, it's $1.18 a month for a residential customer, but the FERC Form 1 provides revenue and sales figures for each of the customer classes and subclasses, so we can look down to the commercial, the largest commercial class, and various other commercial classes, and see what the impacts would be. The largest commercial customer subclass is there would be chipping in 25 bucks a month, or excuse me, 46 cents a month for this program. And you come down to the bottom and you get a total revenue that's generated through this program. So some of the other outputs in this model, we get, we do have to input poverty information, state median income information, minimum wage information, and we get income tables that shows what those income levels are in Arizona specific numbers. But we also get some tables and charts on what the costs, what the benefits are for different sort of hypothetical household groups. Here's a single minimum wage household. Their burden going in starts at 11.1%, ends up at 3.5% when all is said and done through this program. A two-person household at 100% of poverty goes to exactly 5% burden from a 16.1% burden, and so on. There are also charts that are automatically generated. We see this particular chart shows what the benefit, or excuse me, the burden level is for various household types before and after program implementation. There's also a lot of information here on other states' programs and how much money is spent, but I would strongly encourage anyone interested in looking at this model further. If you're interested in working in a new program or revising an existing program in your state, feel free to be in touch. That information is in the slides, how to get in touch with me, and also links to this template as well as the other tools that I mentioned. So with that, we're running late here. I really, again, appreciate the work of the other panelists, and particularly NRRI, for the invitation to sit in and participate with you here today.
John, one quick question then. Is this spreadsheet that you've been going over, is it proprietary to the NCLC, or can the participants get a copy? That was one of the questions. Yeah,
I'm not sure that I'm going to distribute all of this spreadsheet. It depends. It depends on who wants it and what you're going to do with it. I've been working on this spreadsheet for the better part of 20 years, but this is crunch time. I want to get the tool out there, but I would urge folks to be in touch with me. I am more than willing to work with individuals at the state level or local level to develop a specific proposal for you based on what your considerations are. So I'm not guaranteeing you that you get the entire spreadsheet and all the formulas, but I can certainly work with you to develop something customized. And again, for each proposal, it really does not require that long. I've grown accustomed to inputting this data, finding the data, and customizing these tables and charts. It takes me an hour or two to come up with something new for a different utility based on this model. But there needs to be some communication. But really am anxious to work with folks in this important time.
Okay, so for those who are interested, I urge you to reach out to John, and I also urge you to reach out to Bill and Janine, because we've got a lot of questions here, but unfortunately, I don't think we're going to be able to get to very many of them. Let me just overall, Bill, let me reach out to you for something. I think a lot of the participants are looking for really direction on really what should be allowed for recovery of costs, be it lost revenue. Personally, I think that in my view, it's going to depend on the state and what they allow for recovery. Would you like to expand on that?
No, I'll try to expand, but I agree with you. A lot of it, Cheryl, when I've taught classes on even revenue requirements, and we go through different, pro forma or different adjustments. And at the end of the day, when I teach at the Center for Public Utilities, people will ask me, well, what's the right answer for this adjustment? I said, it depends on what evidence is put in the record and what the decision makers decide on, and ultimately possibly the court. So I don't think there's one definitive answer on this. I think it will depend on each individual case and what the evidence is put on by the utility, if there's a trial staff at the commission or a consumer advocate. So I don't have an answer. It'll be case by case, literally.
Okay, John, a quick question for you. The question reads, given that the current unemployment numbers and how they've been growing out there, do you agree that now there's a much broader base and need by residential customers, and not what just historically has been deemed low income, but that there's a new set of customers out there who have financial hardships that they didn't have before? And how should the bill payment assistance program extend to this set?
Outreach is critical. The unemployment numbers are staggering, and one can only hope they will moderate. That's very speculative, but the need for programming such as described here today is absolutely essential, and would just add that for households that are struggling with their bills, but perhaps not income eligible to participate in a program like this, the need for deferred payment agreements is greater than ever, and the terms of those agreements really need to be. I think we need to rethink those in the age of COVID, where rather than becoming more punitive if a customer does miss a payment, utilities and regulators maintain flexibility in dealing with customers who are struggling. And if you miss a payment, well, maybe there should be a second bite at the apple, even for a regular deferred payment agreement, and perhaps extend the period of repayment from the typical 4-month period to something a little less onerous for folks. But if we set them up to succeed, we can do it. It's not rocket science. It just is going to require some patience and some creativity, and also, I believe, well-designed regulatory asset accounts and asset accounts that are contingent upon where recovery is contingent upon good credit and collection practices. But we can do it. It's not rocket science. It just requires us to get out of our boxes a little bit.
Okay. Carl, I think we're getting close to the end of the time. Would you like me to try to fit in any more, or just have the participants reach out to the three panelists?
If we have a question for Janine, I think, spread it around and then we'll call it a day.
I didn't have one in this list other than the one that I'd already asked her previously.
Okay.
Did you have one that for Janine?
Well, yes. So basically, I think, Janine, you talked about that if a utility doesn't have a decoupling mechanism in place, that it's possible to essentially, if a commission desires to move in that direction in a more ad hoc way. Would you like to talk a little bit more about that?
Yes, thank you, Carl. If the utility doesn't have a decoupling mechanism, obviously the best way to do it, to establish one, is through a rate case. But rate cases take a lot of time, and if decoupling is going to be used as an interim mechanism, you may want to look at what the quid pro quos would be to make sure you have consumer protections and that you also have a robust energy efficiency program in place, because that was the original design. But what you can do is, if you put together a mechanism whereby you're looking at the revenue requirements of the utility, my recommendation would be to use a hybrid adjustment mechanism that incorporates the attrition adjustment mechanism and the per customer, because that way you can get a customer count and account for changes in the number of customers, and then you could use the attrition adjustment to sort of work off of what your original revenue requirements were in your last case, and make the adjustment based upon what the current revenue requirements are, taking into account all the factors that I talked about throughout my presentation, and also looking at a number of the questions that Bill raised as well. So an attrition adjustment is sort of a mini rate case. So it's a quicker dive in to make the changes and a quicker examination of the utility, starting it with the premise of what are the current revenue requirements and where do you need to adjust.
Well, thank you, and thank you all. I think that we have a new definition of regulatory asset that we can call out, and the three of you certainly are assets to the regulatory community, and I thank you for your service to us, and particularly at this time. Our next webinar is on the 10th of June. We encourage you all to join us. There's been a great deal of expertise in the last two webinars, and there's more expertise talking about problems that the utility industry has already navigated. Again, that's on June 10th. I wish you all well. I wish you all good health and safety, and look forward to seeing you again on the 10th. Thank you very much for attending today.
Thank you, folks.
Thank you.
Thank you.
Thank you.